Capital call facilities in investment funds, exploring liquidity management in investment strategies. Agenda overview. Introduction to capital call facilities. Mechanisms of capital call facilities. Benefits of using capital call facilities. Risks and considerations. Future trends and developments. Introduction to capital call facilities. What are capital call facilities? Capital call facilities are short term loans for investment funds to manage future capital commitments efficiently. Purpose of capital call facilities. The primary purpose of these facilities is to provide immediate liquidity for investment opportunities and operational needs. Historical background and evolution. Origins of capital call facilities. Capital call facilities originated from the necessity for fund managers to efficiently manage their cash flow needs. Adaptation to market dynamics. The practices surrounding capital call facilities have continually adapted to changing market dynamics, improving efficiency over time. Investor expectations. With the evolution of capital call facilities, investor expectations have also changed, impacting how fund managers operate. Key terminology. Capital commitment. Capital commitment refers to the total amount an investor agrees to contribute to a fund or financing arrangement. Drawdown. Drawdown is the process of assessing the committed capital during specific times or for specific purposes as outlined in financing agreements. Lender covenants. Lender covenants are conditions set by lenders to protect their interests and ensure borrowers adhere to specific operational and financial guidelines. How capital call facilities work. Immediate access to funds. Capital call facilities provide investment funds with immediate access to necessary capital when investment opportunities arise. Seizing investment opportunities. By using capital call facilities, funds can quickly seize investment opportunities without waiting for investor capital contributions. Streamlined capital management. Capital call facilities streamline the management of capital, enhancing the fund's ability to operate efficiently and effectively. Role of the lender and borrower. Lender's role. The lender provides necessary funds through capital call facilities, assessing risk and creditworthiness of the borrower. Borrower's role. The borrower, typically an investment fund, receives funds and is responsible for repayment based on commitments. Creditworthiness evaluation. Lenders evaluate the creditworthiness of borrowers by reviewing their track records and investor commitments. Structure and terms of the facility. Capital call facilities. Capital call facilities provide funds with the ability to borrow against future capital commitments, enhancing liquidity for investments. Interest rates. Interest rates associated with capital call facilities can fluctuate based on market conditions, affecting borrowing costs. Repayment terms. Repayment terms for capital call facilities vary, influencing the timing and method of loan repayment. Covenants. Covenants in capital call facilities establish conditions that borrowers must adhere to, providing security for lenders. Benefits of using capital call facilities. Liquidity management. Importance of liquidity. Maintaining liquidity is crucial for funds to capitalize on investment opportunities quickly and efficiently. Capital call facilities. Capital call facilities allow funds to access capital quickly when commitments are not drawn from investors, enhancing operational flexibility. Timely responses. With effective liquidity management, funds can respond to investment opportunities in a timely manner without delay. Enhanced fund performance. Immediate capital access. Immediate access to capital allows funds to seize investment opportunities without delays, improving decision making. Investment opportunities. With faster access to funds, managers can invest in high potential opportunities, potentially maximizing returns. Enhanced fund performance. Capital access not only boosts individual investments, but also enhances the overall performance of funds. Operational efficiencies, streamlined fundraising. Capital call facilities simplify the fundraising process, making it easier and faster to call capital from investors. Reduced time and effort. By reducing the time and effort required, capital call facilities enhance the overall efficiency of fund operations. Enhanced operational efficiencies. The implementation of capital call facilities leads to better operational efficiencies, benefiting the fund and its stakeholders. Credit risk and lender considerations. Understanding credit risk. Credit risk is a significant factor in capital call facilities that lenders must consider to prevent defaults. Evaluating creditworthiness. Lenders evaluate the creditworthiness of funds and their investors to identify potential default risks associated with borrowed capital. Mitigating default risks. To mitigate the risk of default, lenders implement various strategies based on credit assessments and fund analysis. Potential impact on investors. Investor concerns. Investors may be worried about how capital call facilities affect their commitments and fund performance. Financial health of the fund. The overall financial health of the fund is crucial for maintaining investor confidence and support. Importance of transparency. Transparency and effective communication are essential to alleviate investor concerns and build trust. Regulatory and compliance issues. Understanding capital call facilities. Investment funds often rely on capital call facilities to manage liquidity and investment needs, making regulatory compliance essential. Navigating legal regulations. Investment funds must navigate complex legal regulations to ensure compliance and avoid potential legal pitfalls, protecting their interests. Importance of compliance guidelines. Adherence to compliance guidelines is crucial for investment funds to maintain transparency and uphold investor trust. Using capital call facilities, investment fund liquidity. Capital call facilities provide investment funds with enhanced liquidity, allowing them to respond quickly to market opportunities. Versatile usage. The versatility of capital call facilities enables funds across various asset classes to utilize them effectively for different strategies. Capitalizing on opportunities. Funds can capitalize on timely investment opportunities using capital call facilities to assess the capital they need when required. Impact on fund performance and investor relations. Capital call facilities. Capital call facilities provide liquidity to funds, enabling better management of capital and timing for investments. Enhancing trust. Transparent communication between fund managers and investors builds trust, fostering long term relationships and commitment. Impact on performance. Effective use of capital call facilities can lead to improved fund performance by optimizing investment opportunities. Innovations and capital call financing. Emerging innovations. New innovations in capital call financing are being developed, providing more efficient and attractive options for investors. Enhanced efficiency. These innovations aim to improve the efficiency of capital call processes, making them faster and more reliable for fund managers. Attractive investment options. By leveraging new technologies and structures, capital call facilities can become more appealing to investors, attracting more capital. Shifts in regulatory landscape, evolving regulations. The regulatory environment around capital call facilities is changing, requiring stakeholders to stay informed and adaptable. Impact on funds. These regulatory shifts may alter how funds utilize capital call facilities, affecting their financial strategies. Credit risk assessment. Changes in the regulatory landscape can influence how lenders assess credit risk associated with financing tools. Predictions for the future of capital call facilities. Vital role in investment funds. Capital call facilities are expected to remain essential in supporting the liquidity and operational needs of investment funds. Adapting to market demands. These facilities will adapt to ongoing changes in market demands, ensuring they meet evolving investor needs effectively. Addressing regulatory challenges. Future developments will also focus on navigating regulatory challenges to maintain compliance and investor trust. Conclusion. Importance of capital call facilities. Capital call facilities are vital for investment funds, ensuring flexibility and supporting liquidity in financial operations. Mechanisms and benefits. Understanding the mechanisms and benefits of capital call facilities helps fund managers enhance overall fund performance. Associated risks. While capital call facilities offer advantages, it is crucial to be aware of the associated risks to manage them effectively. Thank you.